Hello learners! Today, we're going to focus on adjusting entries. By the end of this video, you will be able to answer 3 important questions. What are adjusting entries? Why do we prepare them? And when do we prepare them? Make sure you watch this video until the end. And after watching, don't forget to like, subscribe, share, and comment if you find this video helpful. Without any further ado, let's get started. What are adjusting entries? Adjusting entries are journal entries that we prepare at the end of an accounting period, before the financial statements are prepared. Their purpose is to ensure that revenues and expenses are recognized in the correct accounting period. Adjusting entries allow us to properly recognize assets that have been used, liabilities that have been incurred, revenues that have been earned, and expenses that have been incurred. This helps provide accurate and reliable financial information to users of financial statements. Accrual accounting versus cash basis accounting. Before we go deeper, let's introduce an important concept in accounting called accrual accounting. Under accrual accounting, revenues are recognized when they are earned, not when cash is received. Expenses are recognized when they are incurred, not when cash is paid. When we say revenue is earned, we mean that the service has been performed for the client, whether an invoice has been issued and payment is still pending, or the client pays immediately after the service is performed. Similarly, expenses are recognized when the company uses resources, whether payment is made immediately or on account. We also have another concept called cash basis accounting. Under cash basis accounting, revenues are recognized when cash is received. Expenses are recognized when cash is paid. This method focuses only on cash inflows and outflows. However, it is not commonly used in financial reporting compared to accrual accounting. In this video, our focus is on accrual basis accounting, because that is where adjusting entries are required. Types of adjusting entries. Adjusting entries fall into 2 main categories. 1. Prepayments. These involve cash paid or received before the related expense or revenue is recognized. For example, prepaid expenses and deferred or unearned revenues. 2. Accruals. These involve expenses or revenues recognized before cash is paid or received. For example, accrued revenues, which means revenues earned but not yet received, and accrued expenses, expenses incurred but not yet paid. One important rule to remember: cash is never affected in adjusting entries. Let's take an example of Y Company to see how we prepare adjusting entries. Y Company's general ledger shows the following balances on March 31, 2024, before adjusting entries. Prepaid expense, $3,600. Deferred revenue, $1,200. Equipment, $24,000. Accumulated depreciation on equipment, $5,750. Assume all accounts have normal balances. Background transactions. On March 1st, the company paid 3 months of rent in advance at $1,200 per month. On March 2nd, the company received $1,200 in advance for services to be performed. The equipment was purchased on March 1st, 2022, for $24,000 and has an estimated useful life of 8 years. Adjusting entry for prepaid rent. Y Company initially paid $3,600 for 3 months of rent. This amount was recorded as a prepaid expense. By March 31st, 1 month of rent has been used. Therefore, $1,200 should be recognized as rent expense. Hence, we debit rent expense by $1,200 and credit the same amount. This reduces the asset and recognizes the expense. Let's see how we prepare adjusting entry for deferred revenue. Deferred revenue represents services that have not yet been provided, even though cash was received in advance. Since Y Company has now performed the service, The revenue must be recognized. Adjusting entry. Debit deferred revenue $1,200. Credit service revenue $1,200. This reduces the liability and increases revenue. Now let's talk about depreciation. Depreciation expense represents the portion of an asset's cost allocated to one accounting period. Accumulated depreciation represents the total depreciation recorded to date. Using the straight-line depreciation method, we calculate depreciation as follows. Cost of equipment, $24,000. Useful life, 8 years. Annual depreciation equals $24,000 divided by 8 equals $3,000. Monthly depreciation equals $3,000 divided by 12 equals $250. Adjusting entry. Debit depreciation expense $250. Credit accumulated depreciation by the same amount. Accumulated depreciation has a contra-asset normal credit balance, which reduces the book value of the equipment. Why adjusting entries matter? Without adjusting entries, revenues may be overstated or understated. Expenses may be overstated or understated. Assets and liabilities may be misstated. That's why adjusting entries are crucial to ensure that financial statements accurately reflect revenues earned, expenses incurred, assets used, and liabilities settled. That's all for today. Thank you so much for watching. In the next step of accounting, we'll move on to the adjusted trial balance. See you in the next video.